be here making sure everything is good to go for you.
Okay, great. I don't know how to share my screen, but if you tell me, I'll
Great.
try.
Yeah, so right there in the middle, you'll see the green share. If
Yep.
you click that, you should be able to start sharing your screen.
Okay, great. I'll click that first before I go on my PowerPoint slideshow. We'll see what happens.
Okay, perfect. And give me a second. All right, Paul, I have you up. All right, it is 5 o'clock, so we're good to go. So as you go ahead and get that screen shared, I'm just going to go ahead and read your bio right here. Paul Moore is with Wellington's Capital, and Paul is a managing director of 2 commercial real estate funds at Wellington's Capital. He has he has personally completed 85 real estate investments and exits, rehab and managed dozens of rental properties. He co-hosts a wealth building podcast called How to Lose Money and is a frequent contributor to Bigger Pockets. He's an author of The Perfect Investment, Create Enduring Wealth from His Historic Shift to Multifamily Housing. Well, Paul, that sounds very fantastic, and I'm very excited to hear your story and hear on this panel. So go ahead and
All
let's
right,
start.
fantastic. Can you hear me?
Yes, I can.
Can you see my cover slide? Why a multifamily author, yada, yada, yada?
We cannot.
You can't see it.
No.
I wonder why. It's working on my end. What are you seeing?
I see you. So if you hit that share,
Well, that's all
right
you really
there.
want to see, right?
That is right.
Yeah, right, sure. I don't know why.
If you hit that share right there, it should be able to say share screen.
Okay.
There we go. All right, we see it.
There, right? Okay. How's that? Are you seeing a W9 there?
Yes.
All right. Let's see if we can get this working here. Hey, everybody. Glad to be here. What are you seeing now?
We see why multifamily author. We see the PowerPoint.
This is great. It's Friday at 5 o'clock. We're having so much fun, and we can now see my screen. So this is an awesome day. Hey, everybody, thank you for joining me. I know you've got a lot of great choices out there. Kathy Fetke's in room 2. She's amazing, and but we're glad you're here. So I am Paul Moore, and I'm with Wellings Capital. We're based in Central Virginia. I sold my company in Detroit, and we moved to the Blue Ridge Mountains, and never had a good reason to leave. I've been an entrepreneur. I've been proud of being a serial entrepreneur over the years, but then I've learned that it's not always great to be a serial entrepreneur, and I'm going to tell you about that today. I've done over 85 real estate investments and exits. I've written 2 books on real estate investing. I'm working on a 3rd on self-storage and a 4th called Warren Buffett's Rules for Real Estate Investors. I was a finalist for Ernst & Young's Michigan Entrepreneur of the Year twice, and I co-host a podcast called How to Lose Money, and we talk about people's successes and mainly their failures on their road to success. As was previously mentioned, I have a couple of funds with Wellings Capital. We have a growth fund and an income fund, and I love multifamily. And if you read my book called The Perfect Investment, you'll realize that. But today, I'm not going to talk about multifamily. I'm going to talk about why we're expanding outside of multifamily into a few other asset classes. So without further ado, I'm going to turn on my nifty light here and we'll get started. So I do have a podcast called How to Lose Money, and I could get really depressed when I think about all the stupid things I've done on the serial entrepreneur road. You know, like I said, I've been proud to say I was a serial entrepreneur over the years, but I've done a lot of dumb things, like the penny stocks that really were worth less than a penny, and the other great investments I had that were about to blow up. And they really did blow up, but not in the way I expected. Or the waterfront home I built, stick built from scratch, that I thought I was going to make an $80,000 profit on. Instead, I lost $40,000. That guy said he really did know how to do drywall, but I don't think that he really did. That's another story for another day, though. So the great news is I've made a lot of more money than I've lost over the years, and I've had a lot of fun. The great news for you is you don't need to make the same mistakes that I've made or the 190 guests on how to lose money have made. You don't have to make the same mistakes. I can talk to you today about a commercial real estate machine that will generate profits and wealth for you and your children and their children. And we're going to talk briefly about my book, The Perfect Investment. Now, The Perfect Investment is available on Amazon. I'm not here to sell books, but I did write this book 2 or 3 years ago, and it is about multifamily. And I'm going to tell you today why I love multifamily and a little preview. Not only me, but a lot of other people, including people who are watching today, love multifamily. The problem is there's thousands of people who are willing to overpay for multifamily right now, and it's problematic. And so I love commercial real estate, and there's a lot of reasons to love it, but I originally was scared of it. I spent years, and I wasted years, you could say, being scared of commercial real estate. This is the type of mall that I was used to growing up. And as I looked around at malls, the Dayton Mall, where I grew up, it had 29 shoe stores. It had marble floors. It wasn't quite as nice as this one, but it was a beautiful mall. And then years later, I'm exaggerating a little bit, but it looked more like this when I drove back by because, you know, a lot of malls have upturns and downturns. And so when I went back to the mall after college, I looked around and said, this isn't a place I'd want my girlfriend to go and not a place I'd want my future daughter to go. And then I noticed other things. When I quit Ford to make my first run as an entrepreneur in 1993, I was doing this thing. We have these things called newspapers. I'm not sure if anybody's ever heard of that, but we used to clip ads out of the newspaper, and we would go and look at these office spaces to rent. And I just realized, you know, these 1950s beautiful offices from the 50s that were now in the 90s, they were half abandoned. And I really wondered about the fate of all these real estate investors in commercial real estate. But I didn't know the secrets, and I didn't know the power of commercial real estate. And you probably do know, but if you don't, hopefully you will soon. Now, this is Jeff Bezos with Amazon. He's one of the wealthiest guys in the world, maybe the wealthiest guys in the world. And Jeff went around and he removed the light bulbs from the vending machines all over Amazon's facilities. And people wondered, why would he do something like that? He's such a wealthy guy. You know, remember, this is the guy that used a door for his desk for years. Maybe he still does. Jeff knew that the power of $1 at Amazon was very, very powerful. It's worth much more than $1. Here's why. If he could save $1 by not burning the electricity in these vending machines or replacing the light bulb, or having the maintenance guy's salary who went around and replaced these bulbs, he would save much more than $1. So $1 a month for a company like Amazon translates to $12 a year. But let's say their price to earnings ratio, by the way, I don't know their price to earnings ratio, but let's say it's 20 to 1. $12 a year saved is $12 more in income. That's $240 in value in Amazon stock. And that a lot of that goes into Jeff Bezos' pocket. And so we have a similar situation with commercial real estate. And when I say commercial, by the way, I don't mean just retail, industrial, hotels. I mean anything that's large real estate. That includes multifamily over, let's say, 5 units, you know, larger multifamily, especially 100 unit plus. So the question is, how does $1 in commercial real estate, and specifically in multifamily right now, translate into value and wealth? Well, there's got to be a reason that most of the Forbes 400 invest in commercial real estate. And so let's talk about the value of $1 in commercial real estate. So add $1 to the bottom line. And what do you have? That's $1 a month. Now, I'm really good in math, and I realize that that's $12 annually added to income. That could be $1 saved a month or $1 added to revenue. Now that $12 works through a value formula to figure out what the value of the real estate is. So let's talk about that. If you're Chip and Joanna Gaines, I hope you're watching. If you're Chip and Joanna Gaines Jr., at least, you take a $300,000 house and you really beautify it. You put in gold-plated fixtures, you finish the basement, you finish the attic, you put on an addition, you add a pool, and you got $700,000 in it. Now, you and I know that if you go to sell that house, you're not going to get $700,000 out of it if it's in a $300,000 neighborhood. And that's because residential real estate is based on comparables or comps. And that means the value of your home is still going to be the value of most of the homes in the neighborhood, no matter how much you possibly foolishly put into it. Not so in commercial real estate. In commercial real estate, the value of the real estate is based on the income stream. And here's how it's valued. And if you're going to take any notes, this is where I'd take it. The value is the income divided by the rate of return. Now, more specifically in commercial real estate, the value equals the net operating income divided by the cap rate. Now, the net operating income is obvious. That's the net income after paying all your expenses, not including the service on the debt, because the service on the debt is not included in the NOI. So you take the net operating income and divide it by the cap rate. The cap rate is the rate of return that a typical investor would expect for that type of asset in that market at that point in history. And the cap rates used to run about 8 or 10%. Now they're running more like 4 to 6%. Ouch. That means the price is much higher because that's the denominator. So again, value is net operating income divided by cap rate. So $12 annually added to the bottom line, that's $1 a month, is divided by a normal cap rate. Let's be conservative and say $12 divided by 0.06 or 6% cap rate adds $200 to the value of the asset. Wait, we only made $1 extra a month. You're saying it's worth $200 more in value? It's better than that even. That's true. But with leverage, you can multiply it even more to the value of the equity, okay? So what I mean is if you have 60% leverage, you divide, if you're doing math here, you divide the $200 by 1 minus 0.6, in other words, 0.4, and $200 divided by 0.4 is $500. So it's the equivalent of $500 impact on the equity. And if that doesn't make sense, hopefully it will after I give a few examples. So what are some ways to multiply income and into value in a commercial real estate project? So I'm going to go over several different types of projects here. First of all, let's say you had 15 vacant apartments, which is exactly what my company was faced with when we bought our apartments in Lexington, Kentucky 18 months ago. We have 125 units there, and those rent for about $825 a unit. Now, if we can fill 15 vacant apartments, that's 15 times 825, okay? So that's like, what's that? $13,000. Multiply that by 12 months, so that's something like $150,000. Divide $150,000 divided by a 6% cap rate, and that is a significant increase in the value of these apartments. And that's what we're doing right now. What if you could save $25 a month by having the clients pay their own water bills? 25 times 125 units times 12 months divided by the cap rate of, let's say, 0.6 or 0.06. What if you could raise the lot rent at a mobile home park by only 5%? That's $15 a month times 300 spaces. You can do the math on that. It's a huge increase in the bottom line. Negotiate a cable or internet deal. I'm doing that right now at our apartments in Lexington, Kentucky. This is an example I want to take out and really do the math on. So again, if you're taking notes, this would be a good place to take some notes. So a mobile home park that we recently invested in, I'm going to round off the sales price and say, let's say we purchased it for $5 million even, okay? $5 million purchase price on the mobile home park. $3 million of that is a debt. That's 60% loan to value ratio, right? $3 million debt, $2 million in equity, $5 million total. Now, when we got there, the operator went around and he said, hey, this place is a mess. There are boats and RVs and work trailers. And some of these mobile homes have 3 or 4 or 5 or 6 cars sitting in front of them. Let's get rid of some of these cars. We got to do something. So they paved an acre of weeds in the front of the mobile home park. They put a beautiful fence around it, a gate, and they started renting it out to the different residents of the mobile home park. And they said, hey, if you've got a work trailer, RV, boat, whatever, you've got to store it in here, and we're going to charge you for that privilege. So they filled that up, and they're in the process of doing that right now, by the way. And then they're going to go out to the community and say, hey, we've got boat and RV storage. And once they fill up the entire acre, they are going to be making perhaps $10,000 a month. Okay, they only spent $100,000 to do this. So $100,000 expense, $10,000 a month is $120,000 a year in revenue with no significant increased cost other than the capital they put into it. So this $100,000 is getting 120% ROI on it. You can clap your hands like I did and say that's great, but it's much better than that. Because $120,000 with our value formula, $120,000 divided by the cap rate of, let's say, 6%, 0.06, is $2 million increase of the value of the asset. Now, a $5 million asset that just went up to $7 million is a 40% increase in value. And that's really good. That's great appreciation at the asset level. But remember, they only had $2 million in equity in it. All that increased value didn't go to the bank. It went to the equity holders. So $2 million in equity just saw from this one change an increase of 100%. It went from about 2 million to about 4 million on paper. And in reality, it'll probably be better than that because the cap rate might be able to be compressed. We don't know that, but that's what we're hoping. So this is an example of the value formula. It's called forced appreciation. Apartments do it, mobile home parks do it, self-storage operators do it. You can do it if you own commercial real estate. Let's say you add a cell tower. Maybe you add a billboard. All that adds a lot. Add U-Haul. You can. We recently invested in an asset that has U-Haul added to the self-storage facility, and they're getting an extra $3,900 a month. $3,900 a month using our value formula translates to $600,000 or $700,000 in value. It's a big deal. Let's say you add point of sale items like locks, boxes, tape, and scissors to a self-storage facility. Add insurance and late fees. Add admin fees. 800 units times $5 a month is a big, big deal. So that's why I love commercial real estate. And I hope you do too. Now let's step back a little bit and talk about the commercial real estate, the downside of potential commercial real estate. And I'm going to tell you that now. Now you remember Babe Ruth. None of us remember him, but he was the home run king, right? Did you know he led the league in strikeouts 5 seasons? He was also the strikeout king. And the problem with entrepreneurs is we're an optimistic bunch. We love swinging for the fences. We love taking a swing and hoping to defy the odds. And the problem is many of us are able to do it once or twice, but then it eludes us the rest of our life. And we keep rolling the dice and we keep trying to hit a grand slam. And often we lose it all. And like Babe Ruth, become the strikeout king. And if you swing and miss and catch nothing but air enough times, you'll end up losing the money you had. Like Robert Kiyosaki said, if you're a millionaire by age 30 and lose it all by age 40, what have you got to show for it? Nothing but the opportunity to start over again. And I don't want to see any of you do that. I got to tell you the truth. One of the reasons I have the How to Lose Money podcast is that's almost exactly what I did. You see, I believed a lie. There's this lie that, well, it goes sort of like this. The law of risk and return. complete this sentence. Low risk leads to low return. Therefore, high risk leads to what? You're probably thinking high return. That's not true. It's the possibility of high return. And it's also the possibility of no return or a complete loss of your principal. You see, if you keep rolling the dice with all of your assets, all your principal, you'll probably end up losing it all, like many entrepreneurs have. And it's honestly not a good idea. If you want to gamble with 5 or 10 or even 20% of your portfolio, fine, but be willing to lose it. Don't invest any money that you wouldn't be okay with if it was burned up in your fireplace, because that's what often happens with high-risk ventures. Paul Samuelson said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. One of the wisest guys who ever lived is named Solomon, and Solomon said, wealth gained hastily will dwindle, but whoever gathers it little by little will increase it. And so that's my plug for not speculating, not gambling, but actually investing. Now, the difference between investing and gambling in my mind is this. Investing is when your principal is generally safe and you've got a chance to make a return. Speculating or gambling is when your principal is not at all safe and you've got a chance to make a return. Look, if you keep playing double or nothing with all your principal, you're going to land on nothing at some point. What will you have left to double at that point? Many of us, many entrepreneurs experience that, and you don't have to with real estate investing. Multifamily, other commercial real estate investing is inherently safer than many other things. And I can show you why if we have time, and I can show you why the market values it and looks at it as a safer asset. But I don't know that we'll have time to do that. I will tell you why I love multifamily though. Now, multifamily was home ownership was tinkered with by the government. I know you guys all love the government and know how wise they are. But the government in the mid-90s, before many of you remember this, they tinkered with home ownership. And they said, if you can fog a mirror, you should be able to own a home. And they began giving no money down mortgages, even negative money down mortgages, where you got money back at closing. They allowed people to do no-doc mortgages, where you didn't even have to document your income. They would just, a friend of mine literally went and I don't know what he was thinking, but he bought a second home. He was making $40,000 or $45,000 a year. He bought a second home, which was a mansion. I mean, a literal mansion in his hometown in West Virginia, where there was somewhat depressed. He got it for only $600,000, and he made about 2 payments on it, if any, before he lost it back to the bank. A lot of people lost their homes, but home ownership did shoot up. It went up from 63 or 4% up to 69.2% by the year 2005. And that's before it plummeted back to the historic norm of 63% in 2015. And every percentage drop meant 1 million new renters into the renter pool. But that's not all the renters that came in. There were a lot of other renters as well. And the question is, will the United States end up like Germany, where home ownership plummets another 20% down to the low 40s? Will it be like Dallas, which is already below 50% home ownership? Or will it go back up to be more like Detroit, which has 68 or 69% home ownership? I doubt if it's going that direction. And this is one of the reasons that when I decided I wanted, in my 50s, I didn't want to keep rolling the dice. I didn't want to keep taking risks with my capital. I wanted to do something that was more certain. That's when I went into multifamily, and that's why I titled my book, The Perfect Investment. Now look at multifamily's delinquency rates. Now, you know, if you remember, that delinquency rates on some single-family homes were as high as 9 or 10% with local banks around the country in the economic downturn. Now, Freddie Mac and Fannie Mae had lower delinquency rates. They were only up to 4% for multifamily, for single family, but 0.4 for multifamily. So multifamily was only 10% of the delinquency, and that's the bottom solid line you can see here below the dotted line. The dotted line is single family for Freddie Mac. In its peak, we were only 10% as bad as single family, but now we're 98% below the single family level of defaults. In fact, there have been virtually no defaults on multifamily through agency debt, that's Freddie and Fannie debt, in the last several years in the U.S. And remember, these figures, these foreclosures include the high-risk states like Northwest North Dakota or California, Nevada, Arizona, and Florida, where they did have some foreclosures. So the question is, why should we believe this trend will continue? Why should we believe that multifamily will continue to be such a great place to invest? Well, the fundamentals are there. That's why. So first of all, we got baby boomers. Now, baby boomers are the smallest group of renters in the U.S. They're 77 million strong, but they're the fastest growing group of renters. And statistics say that whenever baby boomers go from owning a home to renting a home, they'll likely never go back to owning a home again. You see, in the big crash we had a decade ago, baby boomers who had always believed, and we had heard from our parents and grandparents, that our home was our greatest investment. Well, you know that's not true now, but we didn't. Some of us did. But in general, baby boomers thought that their home was their greatest investment, and they found out that it wasn't at all. They found out they could lose all their money in their home. And so a lot of baby boomers are not enamored with home ownership anymore. But that's not the only people who aren't. Neither are millennials. Now, we used to call these echo boomers, but millennials are the nation's largest demographic group at 80 million. Now, millennials don't see the point often in being tied down to a 30-year contract for a seemingly overpriced home in one part of town when they realize that they might have friends or a job or fun in another part of town next year or across the country or across the world. Millennials have flexibility that most baby boomers never dreamed of. And my hat's off to them. They don't want to get locked in. They don't want to miss the chance for these new opportunities. And frankly, many millennials have record student and other debt and a low propensity to save. They want access to public transportation. They don't like having a car, some of them. They don't like gridlock traffic. And I've been to a lot of these places like Chicago and LA, and I don't blame them. I would want to not own a home either if I was in those areas. Now, the stuff that they're dealing with would have had a little issue before 2007 when they could get a no-doc loan with no money down. But now with tighter restrictions, they have less of a propensity to buy and more to rent. There's a third group that I don't have a graphic for, and that is Generation Z. Generation Z are now about 22 years old and down. They're about 80 million strong too, and they also, it looks like, are going to be a group of largely renters more than buyers. The fourth group is immigrants. Now, immigration is playing an increasing role in the U.S. population. You can see the yellow there shows that from 1970 through 2050, those 80-year span, the immigration population is growing all the time. And immigrants tend to rent more often, and they tend to rent longer than folks who were born in the U.S. And so these four trends, baby boomers, millennials, Gen Z, and immigrants, renting more and more, are making the long-term outlook for multifamily look great. Wait a minute. I was supposed to talk about why I'm not investing in multifamily right now. Uh-oh. Sorry, Dan. Well, let's talk about that. So we already talked about the demographics being strong. I already mentioned, if I wanted to invest anywhere, it probably would be multifamily. They're recession resistant, the default rate's low, but the space is significantly overheated. Cap rates are at a record low, which means prices are at a record high. Why did this happen? Why? Well, let's talk about that. First of all, there's a lot of 1031 exchange money being thrown around right now. People are getting out and selling their assets at record levels. They're making a lot of money, and they don't want to give Uncle Sam a lot of that money, and they're willing to overpay for another asset if they have a chance to save money from the government. They might be willing to overpay on an asset by 10 or 20% rather than give 10 or 20% to the government. A second factor is IRA investors. It's a smaller factor, but there's a record number of self-directed IRA money right now. And sometimes, for whatever reason I don't know, IRA investors are less picky about their investments, and they're willing to overspend on an investment more than a regular cash buyer. There's also international money. I've got a friend in China who raises money for U.S. commercial projects, and he said many of my Chinese investors would be willing to take a zero cap rate, a zero return on investment, just to get in U.S. Commercial assets. And so it's pretty surprising. But my question is this: how can we compete with a zero cap rate? We can't. And so this is a really hard place to play right now when there's international money coming in, but there's also institutional money. That's REITs and life insurance companies. It's very difficult to it's very difficult to compete with these guys who are willing to take a lower cap rate. They generally used to want to play on the coast. Now they're coming to the middle of the country. They generally used to want to be in Class A assets, and now they're taking older assets. They used to want to be stabilized. Now they're willing to do some value add. And it's very hard to compete in Wichita and Lexington and Omaha with these REITs who used to be in LA, Boston, Chicago, and San Francisco almost exclusively. So institutional money is causing a lot of increased pricing pressure. But it's not just that. There's the Tax Reform Act. Now, in November of 2017, a national survey, I think 50% of people, no, I think it was 78% of people said multifamily had already peaked out. It was on the prices were on the decline. I think it was 72% of the people said that, excuse me. That was right before the tax reform law passed. 2 months later, after tax reform in December of 2017, in February of 2018, the same survey, instead of 72% saying it had peaked, I think only 48% of people thought it had peaked. Over 50% thought it still had room to grow, and man, has it grown since. It continues to overheat, and the Tax Reform Act helped do that. There's also something called the NURU impact. Now, you may not have heard of the term NURU, and that's probably because I made it up. NURUs are gurus who are new, or new gurus, people who weren't even investing in multifamily 10 or 12 years ago before the recession. Now they're telling us, hey, invest with me, invest a lot, don't worry about overpaying. It's okay because this time it's different. My friends, let me tell you something. This time, it's not different. That's a lie. Howard Marks, Warren Buffett, all the great investors of our time, Ray Dalio, Charlie Munger, will tell you this time it's not different. And those people are going to lose when the economic cycle turns. Now, many of them who have already, I think, speculated a little bit on appreciation have made a lot of money while I sat on the sidelines. So maybe they were right. over the last several years. Maybe, actually, likely, I was wrong. But nobody has a crystal ball, and anybody who lives by a crystal ball is destined to eventually eat glass. So I'm telling you, like Warren Buffett, who passed completely on the tech boom and was criticized and called a has-been from 99 to 2000, he was right. And I'm telling you that the people sitting on the sidelines on multifamily, not willing to overpay, are going to be proved right in the end. My prediction, I could be wrong. Now, there's also not only Nurus, but wolves in sheep's clothing. What's that? That's folks who actually know that they're lying to you and they can make money from the transaction. Beware of anybody who makes the bulk of their money from the transaction, okay? That's people who get acquisition fees, broker's commission. They make money whether you make money or not. And there's a lot of folks doing that right now. I was at a conference in December, and a speaker got up, and he was a very famous multifamily syndicator. And I was delighted. I thought, I had no idea he was here. He wasn't on the schedule. And he got up and he said, make sure you invest in multifamily right now and don't worry what you have to pay. It's okay to overpay, just get in the game. And I thought he was kidding. I literally thought there was a punchline coming, but he went right on. He wasn't kidding. And his quote went all around the internet because a lot of people realize this is not the advice we hear from people like Warren Buffett and great investors like Ray Dalio. They say, take caution at the top of the market. Be fearful when others are greedy, and you know the rest, be greedy when others are fearful. And Howard Marks has a book called Mastering the Market Cycle that I just finished. And if you want to get that book, you'll learn that this is the time to be very, very conservative and careful in your investments. Now, I don't know if that guy in Miami, Florida was a Nuru or a wolf in sheep's clothing. I wish him the very best, and I hope the very best for him and his investors, but I don't have a lot of hope that that strategy makes a lot of sense, and I'd be very careful in investing in something like that. So here's what happened. About a year and a half ago, we had bought this multifamily, Wellings Capital had bought this multifamily in Lexington, Kentucky, and we had some investors saying, what's next? What are you going to invest in next? And we realized that we were going to have to go outside of multifamily if we were going to make any profit, any headway. And so we asked ourselves, what are some other assets that are recession resistant? We started looking at self-storage and mobile home parks. And I'm going to spend most of the rest of my time talking about these two asset classes. First of all, let's talk about why I absolutely love self-storage. There's a long list, but it's self-storage is recession resistant, and it's actually strengthened in economic booms. Here's what I mean. In downturns, people are downsizing from, say, a 4,000 square foot home to a 2,000 square foot home, or from a 2,000 square foot home to an apartment, and they need a place to store their stuff. Well, for a relatively small price, they can do that in self-storage, and they don't have to give up their grandmother's antiques or their big screen TVs or whatever else they have that they need to store just temporarily. These are only month-to-month leases, and they reason that they're only going to be there a few months till they bounce back, right? Well, self-storage is also strengthened in economic booms, because what's happening in a boom time like now? Well, people are at the Walmart filling up their cart, or in Amazon filling up their shopping cart, and they're actually using self-storage more and more. Now, rents are also inelastic. That's a typo on there. It's my fault. They're inelastic. Tenants are not particularly price sensitive. And what I mean by that is, if I have a $1,000 apartment I'm renting you, and I raise the rent 6%, you might move out rather than pay me an extra $60 a month, which is $720 you're locking in for. But if I raise the rent on your $100 self-storage unit by 6% to $106, from $100 to $106, you're probably not going to take a Saturday, rent a U-Haul, get your friends to move your junk, your treasures down the street to save $6 a month. especially when you realize you're not locked in. You can leave anytime you want. And you assume, I'll probably leave in 2 more months anyway. And of course, that 2-month window keeps moving forward as you continue to stay, and you go through another price increase that's hitting your credit card and you forget about it. There's also high switching costs. And like I said, there's a perception that you won't stay very long. My very favorite thing about self-storage and mobile home parks are the fragmented ownership market. Now, 93% of multifamily owners above 50 units, with apartments above 50 units, are corporations that know how to maximize rent and value. But about 75% of self-storage facilities are independently owned, and 66% are owned by mom and pops. That means one asset owners who don't care, don't know how, or wouldn't even have the resources to maximize income and value. And as we saw from the value formula before, if you can acquire one of these mom and pops in the path of growth and upgrade it, you can make significant income and much more significant added value to your asset, and even more at the equity level. You see, the self-storage industry is actually larger than the combination of all Subways, McDonald's, and Starbucks combined, with about 53 to 54,000 facilities in the US. And there's a perception, and you can even think about this, that it's pretty easy to manage one. Well, it's very easy to manage a mediocre self-storage facility, but it's actually quite complex to manage a great one. And that's who we're investing with now, these operators who know how to manage a great facility. A powerful part of the business plan is to actually not only drive income in the value formula, remember, income divided by cap rate is your value, but also to compress the cap rate. If you can sell to a REIT or a life insurance company, you can often compress the cap rate and dramatically increase value. Mom and pop owners don't reconfigure for the demand. They usually say, well, we're out of 10 by 10s. And if people keep coming to the door looking for 10 by 10s, they'll keep saying they're out. Well, they might have a whole bunch of 10 by 20s that they could add a wall to and create more 10 by 10s. A great operator knows how to do that, and they're configured to change the unit mix if needed. Highly trained staff versus a lot box model. You know, you might think, like I used to, that it made most sense to have an automated system for tenants, but that's not necessarily true. You can actually make more money very often by having a great staff who's doing a lot of marketing. You want to be in a location where it's prohibitive for new competitors to come around, and you want to have the opportunity for low-cost value adds, like adding the U-Haul truck that I mentioned, or like adding locks, boxes, tape, scissors, administration fees, insurance, late fees. Those types of value adds can dramatically impact value, but they don't cost much to implement. Often they're just a change in policies and procedures. Now check out this graph. This graph shows the same property growth in net operating income. Look who's top. Manufactured housing. That's mobile home parks. Look who's second. Self-storage. Look who had the steepest incline since the last recession. Again, self-storage. So we love these two asset classes. And you can see that mobile home parks, which we're about to talk about, had no dip in the recession at all. Now, another reason to love self-storage are the REITs actually did much, much better, much higher ROI in self-storage than any other asset class. And I've got a lot more data on that, but I'm getting a little short on time here. I told you my favorite thing was the fragmented industry. Well, 9 of the top, top 10 largest self-storage companies have only a relatively small portion of the market, about 26% of the market, according to this graph. Now, there's an incredible power to capitalizing on the mom and pop opportunity. Got a little typo here, little or no online presence or online marketing. Mom and pops have limited hours for customer access, no after hours management assistance, little or no online leasing or payment options. And the net effects are these mom and pops are not anywhere near maximizing value. And if I had time, and if you ask me later, I'll tell you about one of my favorite recent stories in growing income in self-storage. I already mentioned this, 93% of multifamily is owned by corporations. There's a significant value in aggregating together a number of self-storage facilities and selling them. You make them all similar. You basically use a franchise model, and then you sell them to a REIT or life insurance company at a reduced cap rate, which means an increased price. And that homogenous group definitely gets a portfolio premium if you have a REIT who likes to buy in that area. So that's self-storage. Let's talk about why I love manufactured housing communities. Warren Buffett does, Sam Zell does, Wellings Capital does as well. So the recession resistant, the switching costs are huge, and we'll talk about that in a minute. Mobile home parks don't have any downturns that we're aware of, and that's what we always hear. There's a shrinking supply. It's unique in that it's the only asset class that we know of that has a shrinking supply every year, but an increasing demand. The affordable housing crisis has meant that more and more people want to get into mobile home parks, and there is a crunch. And there is one of the reasons that mobile home parks are so popular as an investment vehicle is that there's very high switching costs. Imagine you're a tenant at a mobile home park and you just don't like the management or the location or the view or the smell and you want to leave. Well, how are you going to leave? Well, you're going to have to spend about $5,000 to move your mobile home to a new park. That's a lot of money for someone paying $300 or $400 a month. $5,000. If you have a double wide, it'll probably be closer to $10,000 or $11,000 to move the double wide. So it's very, very hard to leave a mobile home park. Now there's also the fragmented issue, and I told you about this before in self-storage. It's even more dramatic in mobile home parks, and you can imagine this as you drive by mobile home parks. Well over 90% are run by mom and pop owners, and they don't care to or know how to maximize income and value. It's the lowest maintenance cost and most predictable capital expense asset class that we know of, but it's got a stigma. And that stigma is mobile homes, nasty. I don't see those as a good investment opportunity. I've heard all this, and I thought this myself. But I'll tell you that Robert Helms has a great quote. He's from the Real Estate Guys. He says, live where you want and invest where it makes sense. This next quote I love. Baby boomers are entering their golden years. 1 in 3 have zero money saved for retirement. 6 in 10 have less than $10,000 saved for retirement. Now, 10,000 people a day turn 65. Many of those folks have home equity, and they're willing to trade in that home equity for a mobile home park lifestyle in many cases. One of my best friend's fathers was a successful doctor in Southern California, and he traded in his home equity to buy a mobile home and move into a nice mobile home park. And a lot of these are a lot nicer than you can imagine. And we're investing in many of those nicer parks. Now, this graph's sort of self-explanatory, but it takes a few minutes to digest it. I'll just tell you the obvious here, that manufactured homes have much, much higher square footage compared to the rent these 3 asset classes: mobile homes, apartments, and single-family homes. The star over the bar on the bar chart there shows the delta, the difference between the amount of space versus the square foot, versus the price. And so here's a quick example of fair market rents compared in these various markets. You've got 2-bedroom apartments in California, well over double the price of lot rent in a mobile home park. You've got places like Florida, again, well over double, Virginia, almost triple, Connecticut, over triple, I think. So you've got a significant disparity in the cost of apartment versus lot rent. Now, the capital expenses I mentioned, look on the far right there. They're the lowest in manufactured housing. They're 3 times higher or more in multifamily. Now, like I said, there is a stigma. Many people view trailer parks like this house on the left. That's nasty. Wait a minute, I own that trailer. No, I'm just kidding. I do have a couple trailers I rent out. And let me tell you, I'm just going to be gut level honest with you folks. I hate them. I hate those rentals. But I love investing in mobile home parks like the one on the right, where everybody owns their own home. And that's what we're investing in at Wellings Capital. We already showed you this graph. This is another graph that shows the projected returns, showing manufactured homes, healthcare, and self-storage at the top of the heap. So when Wellings Capital decided to invest in mobile home parks and self-storage, we decided, like many of you might, to invest passively. So we built a fund that's based on investing versus speculating, high character, high ethics, asset classes that don't lose money, diversification. We go to a lot of trouble doing due diligence. We negotiate investor premiums. We look for geography and assets that are we look for locations that are great, that have income and appreciation. We're also looking for assets that can be purchased right. That we look for professional operators. We look for opportunities to raise the rates, manage the tenant mix, improve the marketing, add other income, add rentable units. And we love the impact on income and value. One of the things I love, mobile home parks are actually beloved, is that a word, by by Freddie Mac and Fannie Mae. And you can actually refinance twice in the first 5 years. And that gives an opportunity to return principal to investors, which means you have a chance for an infinite return. Once the investment is returned, the asset is basically producing an infinite return on investment to the investors. I'm going to take a drink of water. So we're almost done, folks. Then we're going to go to Q&A. So we're looking for operators that have, and we recommend that you look for operators that have decades of experience, who have been through recessions, an experienced internal team, a track record, ethics and integrity, an inside track on off-market deals, franchise-like operations, and the opportunity to exit to an institutional. This is an investment firm that we have been investing with. This is where some of their assets have been over the last 39 years that they've been in business. Here's a recent investment. I believe this is in Lancaster, Ohio. That's how they say it, Lancaster, south of Columbus. This is a mobile home park we invested in. This is another investment we recently made. This is in Aurora, Colorado. It's a self-storage facility that's a beautiful facility. This is in Minot, North Dakota, recent investment. This is a mobile home park in Gillette, Wyoming that Benjamin, my business partner, recently visited, and it's a beautiful park with 500 and some units. And you can see that it's very well manicured and a very nice park. And this is the last picture I'll show you. It's in Austin, Texas. It looks like a Disney facility, but it's actually a self-storage facility. And no, that's not a painting. That's a real picture. That's how nice it looks. This is something we did on our growth fund. It's a ground up development. And this is ground up adding on to an existing facility. I'm sorry, this is on our income fund. This is in Greenville, South Carolina. This is the growth fund. This is near Minneapolis, Minnesota. Now, one thing that's really important to us, and I think it should be important to you as real estate investors, is that we remember that we are creating experiences for people. We're not just investing in little metal boxes that spit out money, as they say. We're creating, these are not just trailers. These are someone's home. Somebody's going to grow up there, and that mobile home park is going to be someone's neighborhood, someone's community, where childhood memories are made, where babies are born, where people live out their last years on earth. So we want to invest with operators who have high ethics, high integrity, and treat people like, not just like numbers, but like people. And so this is a family in Texarkana, and one of my operating partners got to know them, and he was in their office when they were coming in to sign a contract to purchase the home from the mobile home park. And they were so excited. And the little kid said, "What are we doing, Mommy?" And she said, "We're buying a home today." This single mom was able to buy a home and provide a childhood, a place of safety. Perhaps she lived in an apartment before that was much more expensive, and she's able maybe now to not work 2 or 3 jobs. Maybe she's able to spend more time with her kids. Maybe she's able to give her kids a better life than they would have had otherwise. So when you invest, I highly recommend that you take that into account and you invest with an operator, or you be an operator who treats people like people, because everybody is created with wonderful eternal value and they deserve to be treated well. And that's what we look at, and that's what I hope you'll look at as well. Well, thank you very much. Went a little long here, and now I'm looking forward to taking your questions. So what do you got for me?
Paul, thank you very much. Wonderful presentation there. It looks like we have one question in the Q&A, and
Okay.
ladies and gentlemen, feel free to go ahead and submit your questions if you have any right now, but we'll go ahead and, Paul, you can answer this one. Do you evaluate investment locations for self-storage asset classes the same way as you do for multifamily?
Oh, I love that question. Thank you so much, whoever asked that. So multifamily, I could go 15 minutes on this question, but I'll just give you the broad brush answer and hope some other questions come in. So for multifamily, we have about 20 or 23 criteria we use, including large cities, 400,000 or more. We want net population migration that's positive. We want decreasing or less than average unemployment. We want a diversity of employers like healthcare, education, and government. We want to have a basic, not too overbuilt apartments. We want to be in infill locations that are not like urban where new apartments could pop up next door. We have all these criteria, and we are very, very conscious of all those. And it makes it really tough when you're trying to follow all these 20-some criteria to buy a multifamily. And so we had all those, we had all these high standards. And I highly recommend that you have those standards as well, those types of standards. Self-storage is very different. Self-storage can work in very small towns. It can work in areas where there's not a net population migration that's positive. It can work in lots of locations that are not a prime location as you would define according to multifamily. Here's an example. There's only about 4, there's a lot of other criteria, but there's 4 major criteria I'm going to go over now for self-storage. Number 1, the national average number of square feet of self-storage per person is about 7.0. So there are about 7 square feet of self-storage for every person in about a 3 or 4 mile radius. Or it could be any radius. It could be 10, could be 3, could be 1. The national average is 7 square feet per person. So if you find a location and there's only 2 square feet per person, that could be a great location, at least based on that one criteria. If there's 20 square feet per person, places like Boise, it's probably not as great of a place to invest. That's one criteria. Second, you want to have high vehicle count, like 10, 20,000, maybe more vehicles per day passing the location. Third, and this is kind of self-evident, you want to have a great visibility on that site on that highly traveled road. And fourth, you want economic demographics. You want medium to high income in that area. Higher the better, but it doesn't have to be extremely high, but you want to be in a place where there's enough money where someone can afford self-storage. So the 53,000 self-storage facilities in the US, they're certainly not all in locations you'd want to buy in, but many, many more opportunities than there are in multifamily, as I said, especially these days. Thanks for the question.
Wonderful. Great answer. All right, Paul, it looks like we have one more question here. Is collecting rent a issue in mobile home parks? What are the losses incurred on an average?
Okay, great. So you didn't ask about self-storage, but I can tell you that I'm writing a book on self-storage right now. That's where a lot of my focus is. And collecting rent from self-storage is much, much easier than apartments. And the laws are much more favorable to be able to evict in self-storage. I know you didn't ask that question, right? Now, I was trying to put off the question about mobile home parks because mobile home park collecting rent there is somewhat similar to apartments. It's probably a little better because they have so much more to lose if they don't pay. Think about it. If you get evicted from an apartment, you just take your stuff and you leave, and you don't pay your last 1 or 2 months rent. You might have a damage deposit. You might be out, $500 in damage deposit. And of course, you don't pay your last 2 months rent. So you're net positive by, let's say, $700. Okay. In a mobile home park, if you don't pay, you walk away from a mobile home that's worth $10, $20, $50, $80,000. Are you willing to do that? No, most people aren't. And so even though the collections might be a little slower than some places, ultimately mobile home parks almost always collect their rent because people hate to leave behind what is probably by far their largest asset.
Great answer, Paul. Well, it looks like we have one more come in as well. For self-storage, what would you estimate a total investment cost to convert 1 acre of land into a great self-storage facility?
That's a great question. I want to tell you a story in a minute here, so hang on. I would say that the rough cost for grading the land and getting it prepared, so the land cost, could be all over the board, right? I mean, an acre, near downtown Chicago might be in the millions, and it might be literally $5,000 in a rural area. And so the land cost, hard to say. The grading costs, the site prep work, getting the sewage, electrical, everything else out there might be, for example, $20 or $30 a square foot. And again, it depends if you want to go vertical, depends if you're going to do climate controlled, etc. The cost of the actual construction is actually surprisingly moderate. It's probably another $20 or $30 a square foot. And then the cost to do everything else, put the office together, etc., might bring you to a total of, for example, $80, $90, $100 a square foot. For a really high-end, climate-controlled self-storage facility, land included, you might be at something like $100 a square foot. Now, if you can charge $1 per square foot per month, that's $12 a year. $12 a year into 100 means your payback, if you're not even using debt, could potentially be about 8 or 9 years, but that's only on a gross revenue basis. Self-storage net revenues are typically net income, I should say, are typically 66% of gross. So you take 66% of the $12 a year per square foot, that is $8, $8 into 100, that's about a 12 or 13 year payback. But you can sell the facility for much more than $100 a square foot typically. So if you build in the right place and you model it right and you do the right things, you can often get a significant bump in value day one. Now, if it's okay with you, I'm going to tell a quick story. You didn't ask this, but I'm going to cram it down your throat. No, I'm just kidding. Last year, a year ago next week, AJ Osborne on the Bigger Pockets podcast told a story, and you can go find this podcast, of how he went into a coma. Remember the guy who went into a coma and made like $8 million? Well, I'm going to tell you the story. AJ bought an abandoned, I guess you could say, or a vacant super Kmart with over 100,000 square feet in Reno, Nevada. Now, the first thing he did is he sold off the parking lot for several $1 million to an apartment developer. That was pretty smart. Then he cut the building in half to get more exterior perimeter, and he put a beautiful front on it. It looks like a ski lodge or a mega church, and he put beautiful signage out, and then the inside already had nice cement floors, nice high ceilings, and he was able to convert the inside to climate-controlled self-storage. Now, he had a total of about $2.5 million in this project in cash, maybe $3 million cash at most. He also had $5 million in debt. So let's say he had $7.5 million total in this project. He said on the Bigger Pockets podcast, when this is fully occupied, it should be worth over $20 million. Well, AJ and I became fast friends, and I was on the phone with him in December of 2018. And he said, I'm expecting an offer on this any day. I said, wait, I thought you were only 40 or 45% occupied. He said, yeah, but the REITs love this location and they're circling and they want to give us a good price. And while I was on the phone with him, AJ got an offer of $25 million for this facility that he had 2.5 or maybe 3 million in cash in. What's that? Like a 7 to 900% ROI on his cash. Pretty good day, and it only took him 2 or 3 years to pull that off. By the way, AJ turned it down. He thinks it might be worth more. So think about converting an empty building. There's a lot of metrics involved, and if you ask, I can tell you a few of the metrics to look for in converting an empty building. I can tell you that the 4 main location factors I said before are still true for an empty building as well.
Paul, that is a wonderful story, and I'll definitely have to take a look at that on Bigger Pockets. What is a good way for attendees to get in contact with you if they have any further questions that may pop up this evening or this weekend?
Yeah, they can reach out to us at wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com. They can email us info@wellingscapital.com.
Wonderful. Well, thank you very much, Paul, and I hope you have a wonderful evening.
Hey, thank you. It's been an honor to be here. Thanks, everyone, for hanging in there.
Take care.
All right.
All right. I hope everybody enjoyed that. That was very educational and very good. So we do have a couple minutes before 6:15. I want to go ahead and say, do not forget about